Okay, so you want to own a construction company. Buy some trucks, hire a crew, start pouring concrete, and watch the checks come in. Here's the first number that should stop you before you go any further. The largest builder in America, a company called Turner Construction, brought in $29.2 billion in revenue last year. That's more money moving through one construction company than the entire yearly economy of some small countries. And yet, if you looked at Turner's actual profit, the money that's left over after everything is paid for, you'd be looking at a number so small compared to that revenue that it would almost feel like a rounding error. That gap between the giant number coming in and the tiny number staying behind is the entire story of this business. Understand that gap, and you understand construction. Miss it, and you'll go bankrupt owning one of the busiest, best-paying, most respected companies in your city. Let's start with why anyone builds anything this large in the first place. Global construction spending this year is projected to land somewhere around $17 trillion, contributing more than 12% of everything the entire world produces. In the United States alone, the industry moves enough capital that even a sliver of it, captured correctly, makes someone extraordinarily wealthy. But here's the part that surprises almost everyone stepping into this business for the first time. Construction is not a high-margin industry. It is a high-volume, wafer-thin margin industry. A top-tier commercial contractor might book billions of dollars in contracts a year and still walk away with only 2 to 5% of that as actual profit. Capture 3% on a $1 billion infrastructure project, and you've made $30 million. Sounds incredible. Now realize that $30 million came attached to $1 billion of risk, liability, and things that could have gone catastrophically wrong along the way. The appeal was never the percentage. It's the size of the number the percentage is attached to. So before you spend a single dollar, you need to pick your lane, because not all construction is the same business wearing a different hat. Residential builders operate with the fattest gross margins in the industry, sometimes 18 to 25%, but after paying for permits, labor, and overhead, they usually land a net profit of 6 to 9%. Commercial builders, the people putting up office towers and shopping centers, fight over margins as thin as 4 to 7% because every project gets bid against 5 or 6 other contractors trying to win the same job. Industrial and infrastructure work, the highways and the power plants, runs on razor-thin margins of 2 to 6%, but the contracts are enormous and often backed by government money, which means slow payment but reliable payment. Then there's renovation and remodeling, the unglamorous cousin of the industry, quietly posting the best net margins of anyone, 8 to 18%. Because nobody wants to deal with the unpredictability of tearing into a building nobody's opened up in 40 years. And then there's the split almost nobody outside the industry understands. General contractors versus specialty subcontractors. The general contractor is the face of the project. They're the ones signing with the client, coordinating every trade, and absorbing the blame when anything goes wrong. For that privilege, they usually keep 5 to 6% net. The electrician, the plumber, the HVAC crew working underneath them, the specialty subcontractors, often walk away with 6 to 9%, sometimes more, because they carry a fraction of the liability and none of the scheduling nightmare. Here's the part that should make you rethink your entire plan before you even start. The company with its name on the building isn't the company making the best margin on it. The company nobody notices, quietly running the wiring, usually is. Now for the number everyone gets wrong before they even open the doors. People assume you can start a construction company with a pickup truck and a set of tools. You can, if you want to run a one-person handyman operation, which will cost you somewhere between $8,000 and $18,000 to set up. But if you want to build a real company, one licensed to bid on commercial or municipal work, you're looking at $50,000 to over $220,000 before you've poured a single yard of concrete. Here's where that money actually goes, and this is the part nobody warns you about. A used truck and trailer alone will eat $18,000 to $27,000. Basic tools add another $2,000 to $5,000. If you're doing any kind of excavation work, a single piece of heavy equipment can swallow your entire starting budget on its own. Then come the licenses, a few hundred to over $1,000 depending on your state. Then comes insurance, and this is where new owners usually feel the floor drop out from under them. General liability insurance alone runs around $1,000 to $3,100 a year. Workers' compensation averages just over $3,000 annually, more if your trade is dangerous. Commercial auto insurance runs about $2,075 per vehicle. And then, if you want to bid on anything of real size, you need surety bonds, a guarantee to the client that you'll actually finish what you started, and those alone can cost 1 to 3% of the entire project's value. Add it all up, and your first year of insurance and bonding costs, before a single project has even been awarded to you, easily reaches $7,000 to $10,000. But here's the trap inside the trap. None of what I just listed is the thing that actually kills new construction companies. It's working capital. Because payment in this industry moves slower than almost any other business you could start, you need enough cash sitting in the bank to cover payroll, materials, and equipment for 60 to 90 days before your first invoice is even paid. Miss that number, And it doesn't matter how good your work is. Roughly half of all new construction companies fail within their first year. Not because they built anything badly, but because they ran out of cash while waiting to get paid for work they'd already finished. So let's say you've survived the setup. Now you need something even more difficult than money. You need a contract. Projects come from two places: private developers and the government. Private work is relationship-driven. Government work is a different beast entirely, and it's governed by a law most people have never heard of, called the Miller Act, passed in 1935. It says that before the federal government hands you any construction contract worth more than $150,000, you have to post a performance bond and a payment bond, usually equal to the full value of the contract. Why? Because nobody can put a lien on government property if you don't pay your subcontractors. So the government forces you to guarantee it up front instead. Here's the trap almost every new contractor falls into during the bidding process. You'd assume the lowest bid always wins. It doesn't, and honestly it shouldn't. Sophisticated clients use something called best value procurement, weighing your safety record, your financial health, and your track record alongside your price. Because here's the dirty secret of competitive bidding: the contractor who consistently submits the lowest number usually isn't the smartest business in the room. They're the business that made a mistake on their estimate, forgot to include a piece of the scope, and is about to lose money finding that out the hard way. In the industry, this is called the winner's curse. You won the job. Congratulations. You also guaranteed yourself a loss before you poured a single foundation. Now let's talk about what actually happens once you've won that contract, because this is where the real education begins. Every project is its own tiny economy, broken into 4 buckets: direct costs, materials, field labor, equipment rentals, subcontractor payments, permits. Indirect costs, site supervision, temporary utilities, project management, and overhead, the corporate costs that exist whether you're building 1 project or 10, things like office rent, salaries, insurance, and software. Materials and subcontractors usually eat the largest slice of the direct cost pie. But labor is the most dangerous line item, because labor is the one thing that can silently balloon without anyone noticing. If your crew was estimated to need 400 hours for a task, and it actually takes them 500, you don't get to bill the client for that difference. You eat it, directly out of your profit. And this is where the trap structure of the entire industry becomes brutally clear. With net margins hovering around 5 to 8%, a single serious mistake, pouring a foundation 18 inches off the mark, say, can trigger enough rework, delay, and wasted material to consume 10% of the entire project budget. Do that math. Your margin was 8%. Your mistake cost 10%. You didn't just lose your profit. You paid for the privilege of building the thing. Materials themselves are a business within the business. You're managing concrete, steel, lumber, electrical switchgear, and plumbing fixtures, and in the current environment, prices are moving in ways that would have seemed absurd a decade ago. Steel and metal framing prices have climbed around 18% in the past year alone. Lumber and engineered wood are up close to 12%, and tariffs on imported steel and aluminum have pushed the effective tax on some construction materials to a 40-year high, somewhere between 25 and 30%. If you locked in a fixed-price contract before that spike hit, you don't get to renegotiate. You simply absorb it. This is exactly why experienced contractors write escalation clauses into every contract. A rule that says if a named material rises past a certain threshold, the client shares the extra cost. Skip that clause, and a 20% spike in lumber prices comes directly out of your own pocket. On a project you already thought was profitable, labor deserves its own conversation, because it is, without question, the single most unpredictable expense you'll manage. The industry currently needs roughly 500,000 net new workers just this year to keep pace with demand, and more than 40% of the existing skilled workforce is expected to retire within the next 5 years. That scarcity is pushing wages up around 4% annually, and it's creating a mistake that quietly bankrupts new contractors, estimating a job using the worker's base wage instead of their fully burdened rate. Here's what that actually looks like. Say a carpenter earns $25 an hour. Add roughly 17% for payroll taxes. That's about $4.25. Add another 12% for workers' compensation, $3. Add 15% for benefits and insurance, $3.75. Suddenly, that $25 worker is actually costing you around $36 an hour. Estimate a job using the wrong number, and you have mathematically guaranteed yourself a loss on every single hour your crew works. And you won't find out until the project's already finished. Heavy equipment brings its own version of the same decision every contractor eventually has to make. Do you buy it or do you rent it? The honest answer depends entirely on something called your utilization rate, meaning how much of the time that machine is actually out there earning money instead of sitting in your yard. Below 40% utilization, renting wins every time because ownership costs like depreciation and storage outweigh whatever you'd save. Above 65%, ownership wins because you're building equity and lowering your cost per hour. And here's an underused advantage in the American tax code, Section 179. It allows you to deduct the entire purchase price of qualifying equipment in the same year you buy it. instead of spreading that deduction out over a decade. Buy a $75,000 machine while sitting in a 35% tax bracket, and you could see roughly $26,250 in immediate tax savings, dropping your real cost to under $49,000. That single piece of tax code has quietly shifted thousands of contractors from renting to owning. Now let's talk about the costs that don't show up on any estimate, because these are the ones that actually destroy companies. Rework is the industry's quiet killer. Research from the Construction Industry Institute puts average direct field rework at around 5% of total project cost, ranging as high as 12% on complicated commercial and industrial jobs. On a $50 million project, an average rework rate is $2.5 million in money that simply vanished. Not stolen, not lost to fraud, just poured into tearing out and redoing work that should have been done right the first time. And because crews usually just absorb that corrective labor quietly into their daily hours, most companies never even formally measure how much rework is bleeding them dry. It just shows up eventually. As a company that somehow isn't as profitable as its revenue suggests it should be, then there's safety, and this is where the numbers turn genuinely frightening. A serious OSHA violation currently carries a maximum penalty of around $16,550. If that violation is ruled willful or repeated, the fine jumps to $165,514 per violation, not per inspection. Fall protection is consistently the most cited violation in the entire industry. Because fines are counted per worker, a single inspector finding several employees on a roof without harnesses can generate a fine large enough to erase your entire year's profit on that project in one afternoon. And that's before anyone considers the lawsuits or the far more serious consequences that follow if someone actually gets hurt. Now here's a real company, a real name, and a real collapse, because nothing teaches this lesson better than watching it happen to someone who was supposedly one of the best in the business. Meet Carillion, once the second largest construction and services company in the entire United Kingdom, employing over 43,000 people, running government hospitals, schools, and highway maintenance contracts across the country. In 2016, Carillion looked, on paper, like a company at the peak of its power. It had just paid its shareholders a record dividend of £79 million. It was winning contract after contract from a government that trusted it completely. And yet, 10 months later, on the 10th of July 2017, Carillion shocked the market by announcing it was writing down £845 million in the value of its own contracts. Its share price lost 70% of its value within 2 days. By September, that write-down had grown past £1 billion, larger than the company's previous 7 years of profit combined. By January of 2018, Carillion collapsed into compulsory liquidation with just £29 million in cash and liabilities that eventually totaled nearly £7 billion. So how does a company that large, run by people who understood construction better than almost anyone in Britain, collapse this completely, this fast? The answer isn't incompetence, it's structural. Carillion had been growing through acquisitions funded almost entirely by borrowed money, bidding aggressively on low-margin public contracts to keep revenue climbing, and using an accounting practice called reverse factoring to disguise how much it actually owed its suppliers. It kept paying rising dividends every single year, even while its underlying cash position was deteriorating, because a falling dividend would have signaled weakness to the market. It was desperately trying to keep calm. In other words, Carillion wasn't destroyed by one bad decision. It was destroyed by the exact same forces already sitting inside your own business plan. Thin margins, heavy borrowing, and a public image built on projects that were quietly bleeding money the entire time. Keep that in mind the next time a bid looks too easy to win. Before we get to how the money actually flows, there's a second layer of risk sitting underneath everything I've already told you, and it has nothing to do with a single bad project. It's the industry's plumbing itself. The sheer amount of time between doing the work and getting paid for it. Every business has a metric called Days Sales Outstanding, or DSO, the average number of days between sending an invoice and actually receiving the cash. A software company might see a DSO of 5 to 45 days. Construction averages 60 to 90 days and often longer because every invoice has to move through a chain of approvals. Your own project manager, the architect, the client's financial controller, sometimes even the bank funding the project, before a single dollar moves. A subcontractor who pays for labor and materials in June might not see that money until September. In the meantime, payroll doesn't wait for approval chains. It comes due every 2 weeks whether or not you've been paid. Layered on top of that slow payment cycle is a practice called retainage. To guarantee you'll actually finish the punch list and fix every small defect at the end of a job, the client legally withholds a percentage of every single invoice, typically 5 to 10%, until the entire project reaches final completion, sometimes months after the building is already standing. Do the math on what that actually means. If you're running a 6% net margin and the client is holding back 10% in retainage, they are, for the entire length of the project, sitting on more cash than your entire expected profit. You finish the building in a structurally negative cash position, surviving purely on a line of credit, waiting for a final payment that might not arrive for months after the work is done. There's a third number quietly determining whether you're even allowed to compete for future work, and it's called the Experience Modification Rate, or EMR. It's a multiplier applied to your insurance premiums based on your last 3 years of workplace injury claims. An EMR of 1.0 is the industry average. Let a few serious injuries push your EMR up to 1.3, and your insurance premiums jump 30% overnight. Worse than that, most major developers and every government agency will simply refuse to let you bid on their projects if your EMR climbs above 1.0. A bad safety record doesn't just cost you money. It quietly locks you out of the market entirely, regardless of how good your work actually is. Once a company survives all of that and starts winning more work than it can chew, everything changes again, because now you're not managing one project. You're managing 5 or 15 or 50 simultaneously, and the challenge stops being physical and becomes purely financial. Every contractor at this stage relies on something called a work in progress schedule, or WIP, which tracks the percentage of completion on every active job by comparing costs already spent against total estimated costs. Buried inside that WIP schedule is a distinction that decides whether a company sinks or swims, the difference between overbilling and underbilling. Overbilling means you've invoiced the client for more of the project than you've actually completed. It looks like a liability on paper, technically unearned revenue, but in practice it means the client's money is financing your work, which is fantastic for your cash flow. Underbilling is the opposite, and it's far more dangerous. It means you've already done the work and paid for the labor and materials, but you haven't invoiced for it yet, often because of a slow approval process or a disputed change order. It looks like an asset on the books, but in reality, you are using your own cash to fund someone else's building. Chronic underbilling, quietly bleeding a company dry invoice by invoice, is the single most common reason a construction company that looks profitable on paper still runs out of cash and closes its doors. For the companies that navigate all of this successfully, growth eventually stops looking like construction at all and starts looking like corporate finance. Expanding into a new city means learning an entirely new set of municipal codes, labor unions, and material supply chains from scratch. The largest firms eventually stop simply building for other people and start developing real estate themselves, buying the land, arranging the financing, and acting as their own client, which lets them capture both the construction profit and the long-term value of the finished asset. Reaching that scale requires something called bonding capacity, essentially a ceiling set by surety underwriters based on your balance sheet and liquidity, determining the largest public project you're even legally permitted to bid on. Grow faster than your bonding capacity and your accounting controls can support, and you're simply building a bigger, faster version of the same collapse that took down Carillion. So who actually gets paid at the end of all of this, and how much? An owner's income in this business comes from two very different places: a regular salary and a year-end profit distribution. Industry best practice puts a reasonable owner's salary at around 8 to 10% of total company sales, treated as a legitimate overhead expense rather than a bonus. Beyond that, whatever profit remains at year-end gets split between what the owner takes home personally and what stays inside the company to fund next year's working capital. A small independent contractor might land somewhere between $50,000 and $150,000 a year in total personal income. The owner of a scaled, efficient mid-market firm, one that's mastered its cash flow, its bonding capacity, and its change order strategy, routinely takes home $300,000 to well over $1 million annually. Same industry, same tools, same physical work happening on the job site. The difference between those two outcomes was never the quality of the construction. It was the discipline of the accounting sitting behind it. So how does anyone actually make money in this industry, once you strip away the disasters? It all comes down to the shape of the contract. A fixed-price contract puts all the risk on you. You eat every overrun, but you keep every dollar you save. A cost-plus contract flips that entirely. The client reimburses your actual costs plus an agreed fee, which is safer but removes almost all incentive to be efficient. A guaranteed maximum price contract splits the difference, capping your risk while sharing any savings with the client. And design-build contracts, where you handle both the architecture and the physical construction under one roof, let you start building before the design is even finished, which speeds everything up and reduces disputes between separate parties. But here's the mechanism that actually rescues most contractors' margins: the change order. Once you're already on site, mobilized, and the client has essentially no leverage to bring in a competing bidder mid-project, any request for a design change or any surprise condition hiding underground, old bedrock nobody knew was there, say, gets priced with a far higher margin than your original competitive bid ever had. Change orders are, quietly, where a huge percentage of real profit in this industry actually comes from. Now let's do the math the way any serious contractor would, because the two-scenario ending is the only honest way to end this conversation. The optimistic scenario. You're a mid-sized commercial general contractor booking $50 million in annual revenue, running at a healthy 6% net margin. That's $3 million in profit for the year. Your projects came in on schedule, your material costs stayed roughly where you estimated them, Your safety record kept your insurance premiums flat, and your change orders added a comfortable cushion on top of your base bids. Life is good. You're the contractor other contractors envy. Now the realistic scenario. Steel prices spike 18% mid-project, and you didn't have an escalation clause protecting you. A single foundation error triggers rework that eats an extra 5% out of one major job. An OSHA inspection catches 3 workers without proper fall protection, and the fine alone runs past $165,000. Add in the fact that your average client is taking closer to 90 days to pay you instead of 30, and now you're financing your own payroll out of a line of credit just to keep the lights on. Run that same $50 million year through that reality, and your 6% margin doesn't just shrink. It can flip into an outright loss. Walk through the actual numbers with me, because seeing them side by side is more convincing than any warning I could give you. In the optimistic year, $50 million in revenue at 6% net leaves you $3 million richer, and your backlog going into next year looks strong enough to justify buying that second excavator you've been eyeing. In the realistic year, that same $50 million in revenue, hit by an 18% steel spike with no escalation clause, a 5% rework hit on one job, a $165,000 willful safety fine, and a 90-day payment cycle forcing you onto a line of credit, can turn that same 6% margin negative before you've even accounted for interest on the debt you took on just to make payroll. You didn't build worse buildings in the bad year. You built the exact same buildings. The only thing that changed was which side of a handful of coin flips you happened to land on. The difference between a good year and a bad year in this business is measured in millions of dollars, on the exact same revenue, built on the exact same contracts. That's not bad luck. That's the actual architecture of this industry. So is owning a construction company worth it? It gives you an entry point that skilled people can genuinely reach, contracts measured in numbers most industries never touch, and the rare, tangible satisfaction of physically changing the skyline of your own city. But it demands an owner who treats the business less like a builder and more like a financial institution that happens to produce buildings. Someone who understands retainage, cash conversion cycles, and burdened labor rates as fluently as they understand concrete and steel. Every single number in this script, the thin margins, the slow payment cycles, the retainage trap, the burdened labor rate, the fine print buried inside a fixed price contract, exists for one reason. It filters out the people who wanted to build things from the people who actually understand what they're building. The tools, the trucks, and the crew are the easy part. Anyone with enough starting capital can assemble those in a matter of weeks. What separates the contractor who's still standing in year 10 from the one who quietly disappears in year 2 is whether they treated their own cash flow with the same seriousness they treated their blueprints. The people who thrive in this industry were rarely the best carpenters in the room. They were the ones who understood, long before their first project broke ground, that the real business of construction isn't building things. It's surviving the gap between what you're owed and what's actually sitting in your bank account.